When times are good, you tend to forget that times can be bad. And when times are bad, you tend to forget that times could be good again. We've been in a pretty deep recession for the last 3 years now in multifamily.
It feels like everyone around me is rich but us right now.
Yeah.
People in real estate.
A lot of what we focus on in that 30-minute ring stuff is really gray collar housing, $55,000 to $100,000 household income demo. And you're going to commute maybe 35 minutes, but you're getting a 20% cost of living savings for being in this submarket.
If you didn't self-manage or you weren't a great self-manager, you could get saved by rent growth. Now you got to really be on the ball and you got to really be sharp.
We didn't lean in and go the institutional route when we probably could have. We really continued to focus on our private capital relationships. We probably have about 300 active investors at this point. We want to buy good assets at an attractive basis, take advantage of the dislocation that's in the market. It might not be distress, it just might be seller timing. This one's not ugly enough for me when we show them a 23 vintage deal. Like, just because it's not ugly doesn't mean it's still not a great deal.
Crazy how conditioned we've been. Every time we see a dilapidated asset, we just get so excited. Like, wow, and so much opportunity.
Absolutely.
All right, welcome to another episode of Deal Flow Friday. I'm your host, David Mogavam, and today we got Chris Urso, managing partner of Urso Capital Partners, another fellow multifamily operator who's also vertically integrated with a strong proven track record across the Southeast and beyond. Chris and his team and Tryon and our team, we've done a few transactions together. They're a great shop, generally play in some of the Southeast markets. So I'm really excited to talk shop with you, Chris. It's really great to have you on.
Yeah, great to reconnect, David. I appreciate you having me on. Very excited to kind of share some of our stories with the audience.
Definitely excited to share the stories, share what we're seeing out there. Quick tidbit of Urso Capital Partners track record: 37 deals acquired since 2009, 4 ground up, around 6,000 units, 23 assets sold, 269 investors, $1 billion plus in transaction volume, and continuing to grow. Also, Chris,
a lot of gray hair along the way,
and a lot of gray hair along the way. Exactly. Especially after, the rate hike 3 years ago and kind of where we're at now. So segueing into that, have you seen 2025 play out for you? Is it what you expected? And what are you seeing out there right now overall on a macro perspective?
So I do think, listen, it's an interesting time, right? For those that aren't in our space, and I have to remind our investors of this a lot of times, and folks that we talk to that aren't in our space every day, like you and I are, we've been in a pretty deep recession for the last 3 years now in multifamily. The rest of the world might not have been, but we've been in a recession for the 100%. Last 3 years.
I feel like I was always saying, like, it feels like everyone around me is rich but us right now. Yeah. People in real estate. It's painful. It's painful.
Yeah. But I think for us, we do a year-end like big report to our investors where I kind of give my thoughts on the past year and then looking forward. And I have to constantly pull that back up because it reminds me that 25 has really played out exactly how we thought it was going to be. We thought it was going to be a really challenging year operationally. We didn't feel like we were on the other side of supply. I listened to all the big REIT earnings calls every quarter, just kind of get their pulse. And, when you were listening to Q3, Q4 of 24, they were all calling peak supply in all the markets, and 25 is going to, second half of 25, we should be, back seeing light at the end of the tunnel. We felt in our markets that, deliveries weren't going to really be peaking till probably Q1, Q2, if not Q3 of 25. And it's played out that way. We've been very active on the buy side, but we've been telling our investors like, hey, we're expecting the first 12 to 24 months to be a challenge, but we think there's good opportunity out there. If we can muscle through this, we can get to the other side. We feel like once we get to back half 26, 27, 28, 29, we're going to start to see that normalization. But long answer to a short question, 25 really kind of has played out almost thematically how we expected it to. we're starting to see a little bit more on the buy side, some exciting stuff come to fruition where it was like we saw opportunities Q4, Q1, then Q2, Q3. I thought I was never going to buy another deal.
Yeah.
And then all of a sudden in Q4, it's like we were seeing these pockets of motivation slash distress slash dislocation starting to show their face more frequently. So I think there's some more of that to come here in the next kind of couple of quarters as we move into 26.
Yeah, I think the supply wave was really hitting in the, deliveries in 2024, but that doesn't mean it all gets absorbed so
The
quickly, right?
absorption,
And we're still chopping wood
100%,
with absorption. And so where does that
100%.
translate to? It translates to a little bit lower occupancy levels, a little bit of concessions that you have to work through. I think, I actually enjoy listening to your quarterly updates. And I think you gave
Thank you.
a pretty good term of earning your occupancy
Yeah,
every day. Cause that's really what it feels like. It feels like
100%.
you're competing for occupancy. And the good news is I feel like there's light at the end of the tunnel, right? In some of our markets, maybe some more than others in terms of that supply glut that hit. Um, and I think that might be where you're saying we might be seeing some opportunities. Talk to me about kind of where are the markets that you're most bullish on, maybe even starting from a supply standpoint.
Yeah, I mean, I think we look at that closely on the supply side. We're tracking completions, right? Because that's really what we're up against in the near term. As you know, the data on ground up development is still so ambiguous in our space. Nobody's gotten it really right in
Yeah.
terms of being able to see what's coming in the future clearly. But what we can track is what's coming out of the ground and what's going to be delivered. So we really look at completions kind of in the next 12, 24, 36 months as kind of a key short-term metric, keeping an eye on the whole plan perspective and entitlement, pipelines within our respective markets at the same time. But I'd say, for us, we're seeing big drop-offs in Charlotte, for one of the larger markets. I think you're going probably from around like 30,000 units in 25 to like 10,000 in 26 that are forecasted. And I think 5,000 in 27.
And
That's pretty
from a percentage of total supply, that feels pretty good too, right? Because it's such a large
absolutely.
market.
Yeah. It's one of the larger markets.
Yeah.
Exactly. When you start to get down to that single digit thousands range, you're talking about a couple of percentage points in a market like Charlotte of inventory. Nashville's a similar theme. I think everybody's been following that for years. It feels like they've been digging out of the supply dump down there. But we really love, not to get too deep, but from a submarket perspective, Murfreesboro, Tennessee, like we tend to play more in the 30-minute rings
Hmm.
of
First
like
ring suburbs.
yeah,
And yep.
verse kind of close in. Um, Sorry, God, I didn't know.
No, I was gonna say that's, and that's very similar to where we play. And I think that's why we've crossed so many paths so many times. We like those first ring suburbs. And I think what you're finding is the supply glut, and I don't want to overgeneralize, obviously, but some of
Yeah,
these primary markets, they're a lot more on like the urban
very
core
concentrated.
or by like the belt line, like in Charlotte, for
Mm-hmm.
instance, where there's a little more supply insulation in some of those first ring suburbs that your group and our group like to play in. Um,
100%. I
yeah,
think a great example for us, like we are ultra bullish on Murfreesboro, Tennessee. We've owned down there now for almost 5 years. We're buying another deal that's closing in January down there. It's within Rutherford County, fastest growing county in Tennessee. Major like barriers to entry down there. Population growth's been tremendous. I think they're delivering one deal in 26, 300 units. And it's a market of, 170,000 people just in Murfreesboro. And then you couple that with kind of a a 500,000 person, county. uh, it's almost immaterial, and zoning's a challenge. So we look for things like that from the submarket side. But we're seeing new starts down, right? I'm sure you guys are tracking that, which is a positive. Everything takes more time in our business, I think, than people realize
yeah,
to see the effects for better or worse. So we're not going to really see the benefits of these new starts that are dropping, to kind of decade low levels, for another 2, 3, 4 years potentially. As we're seeing the effects of 50-year high supply 2, 3, 4 years after these deals were started. So I think, again, from the market side, to kind of wrap that up, it's like Charlotte, Nashville. We own in Leland, Wilmington. We're buying another deal down there. That was a really heavy supply hit area, but you're going from, in a small market, 3,000 units to like less than 1,000 units being completed next year,
Yeah.
versus this year. So I think it's, you gotta muscle, like we said, muscle through. But as I follow Howard Marks, I don't know if you follow him at all, but he has a great podcast where he kind of does his memos. Now he's turned into a podcast, and he has one of the best lines ever, right? The best of deals are made in the worst of times, and the
Hmm.
worst of deals are made in the best of times.
It's
And
the
when times are good, yeah,
fear greed analogy that,
it
you know,
is. And it's
Buffett
also as
always,
simple as
yep.
like, when times are good, you tend to forget that times can be bad. And when times are bad, you tend to forget that times could be good again. So it's just trying to make smart decisions in good markets that you want to be in for the long term, and understanding the dynamics of not just the market, but really the underlying submarkets, which are critical to our business.
Yeah. And speaking about the different sub markets or different MSAs, you and I, we both play in these primary markets, the Atlantas, the Charlottes, the Nashvilles, and then we play also in these secondary markets like the Charlestons, the Savannahs. And I don't know about you, but what I'm definitely seeing is some of these secondary quote unquote markets are pricing tighter. They're pricing a little bit, they're a little bit more, have a little more cachet right now from an investment perspective, because maybe they didn't get hit with the supply glut that maybe some of these primary markets saw. Are you kind of leaning in on those secondary markets right now where you're seeing that, okay, because it's a little bit less supply, I'm a little more insulated, it might be a little bit of a better play longer term? Or are you kind of capitalizing on these high supply areas that you're saying, all right, this is a blip, let's trug through these next couple of years, and then when supply eases off, we're going to see the benefits?
So I think it's a little bit of both. I'm definitely biased to Charleston. I'm one of the guys that definitely loves Charleston,
Hmm.
as many do. But we've been investing in Charleston since 2012. I mean, pre-airport, Boeing had one facility. We had about 1,100 units at one point at the peak down there between 2012 and, call it, I think we sold our last asset in December of 22, um, in Charleston, and we just re-entered back in Somerville. We bought a fairly newer deal from a developer, 2-year-old deal, and we want to continue to expand there. We do feel like, again, out of all the kind of quote unquote secondaries, I guess Charleston's probably the most mature and has the best underlying fundamentals with real barriers to entry, from just geographic challenges and wetlands, things of that, anchored by water every which way, plus just the density of development that's gone on there. But it's got real jobs, it's got real population, it's got diverse employment, and you're really truly seeing a path to the supply dump being kind of complete here in the next 12 to 24 months, and total normalization. But it's tight, to your point.
Yeah,
There's now there's a lot of money that have that same thesis. So it takes a lot of work. It's always been a market that you have to put the time into, much like some of these other like boutique secondary markets that have good fundamentals. You have to put the work in. So we do like them. We won't go beyond kind of the Charlestons and Savannahs. We do own in Asheville. That's probably as kind of like secondary, tertiary that we'll go. We do really like playing in the Charlotte, again, that 30-minute ring, Charlotte, Nashville, Raleigh, Atlanta has been a primary focus for us to re-enter that market. We do think that it was probably one of the first hit and hardest hit, and that is starting to really, from the deals that we're underwriting, you're starting to actually see positive trade outs in certain
totally.
submarkets.
Completely.
Bad debt is down to low single digits versus high double digits,
That's not
which
like
was
something
interesting.
great to be proud of, but yes,
Yeah.
exactly. It is getting better. It is getting better.
And I think you do that, to your example there, because of the size of the market. And we track the transaction volume really closely. Atlanta, quarter over quarter, is hands down, it's obviously the largest market, but most amount of transactions, most transaction volume there, given the size. But I do think that's where you can sneak in one of those larger markets, like the primaries down there, and get some really good relative value,
For sure.
because it is a larger market. There's a lot more opportunity, and there's a better chance to kind of sneak in on something that somebody misses. Where, a deal comes out in Charleston, you have 100 sets
Exactly.
of eyes on it the first day it comes out.
Exactly.
Um,
Like
because only,
the macro
yeah.
stuff we were talking about on Charleston. You have, the barriers to entry, the tight supply. You also have on the demand side, like huge inbound migration. I think from a
Huge.
percent of population, it's one of the fastest growing MSAs. So you'll see that. And then you zoom in, you see, okay, less velocity, trade velocity, which leads to more competition. So at what price are you really getting into
Mhm.
Charleston? Then you looking at an Atlanta, and Atlanta has been written off by a number of institutions because they got burned, justifiably so. Coming out of COVID, bad debt got off the rails, and there was no path to working through that. It was a market, situation. It wasn't really operationally specific. Now what you're seeing is Atlanta's in the last innings of that issue, whereas all these other markets that we play in are all only in the first inning of these bad debt issues. And so I think you're seeing a really good risk adjusted return in some of these first ring submarkets in Atlanta.
I completely agree, and I think you have the ability to trade up, right?
Hmm.
In terms of like vintage and quality to where it, in the past cycle, it just wasn't accessible. If you were looking for value, I mean, people were paying 200, 210, 250 for 90s vintage product or 80s vintage product in some instances. Where now, I mean, we're seeing deals, 140, 150 for late 90s, early 2000s vintage in some of these outer suburban submarkets where supply has pretty much come to a halt. um, it's all got to make sense
Diversified
at the end of the
economy
day.
base
Yeah,
too, right? Good
absolutely.
jobs, strong jobs.
Yeah.
Like sometimes with some of these secondary markets, it's a little bit too employment specific and a little too reliable on one employer. Whereas like in Atlanta has, I think, some of the biggest numbers of Fortune 500 companies, right? And
Yeah.
so it's diverse. It's not just leaning in on one employer to drive up the rent.
And the smaller markets are much more exposed to, when you do have pockets of supply, right? They don't have it has a meaningful impact on your operations. We own in Beaufort. We bought a deal down there. We like it
Great
a lot
market,
for the long term, great
great
market, but
demos.
all of a sudden, like to the reporting side on new development, we did all the pipeline work, pre-purchase. There was nothing, nothing, nothing. A year in, all of a sudden, guys putting a deal up down the street, 400
Mm-hmm.
units.
Mm-hmm.
400 units in a market like Beaufort, everybody feels it.
Yeah.
It's Atlanta, that can get picked up and it's kind of gets blended through and nobody really has a, material feel or implication from that. So I think that's one thing that you do have to pay attention to when you move into some of the smaller markets and the sub markets where supply, even two or three deals going up can have a meaningful impact for 12, 24 months, if not 36 on your
Yeah.
assumptions.
Yeah. So I actually want to get back to how you guys, you know, again, similarly, we both kind of attack these first ring suburbs. I'd love to hear
Yeah.
from you, and I could kind of give my take too of like, how did you fall into that strategy? Because it's, I think, through cycles at this point with Tryon, we've always found ourselves getting into those first ring suburbs. Now, as much as people say, oh, return to core, everyone wants live, work, play, or oh, it's COVID, everyone's moving to the suburbs. We've always kind of stuck still to that first ring suburb, and we've always found it to be a great place to play. I would love to hear kind of from you on your thesis through cycles, how
Yeah.
you guys gotten comfortable with the first ring suburbs.
Yeah, and I think that's really much like you guys. When we look back, that's really been kind of where we've ended up, for better or worse. And I'm very happy with it. I think for us, it's we're opportunistic by nature, both in kind of submarket selection and asset selection and profile, and we look for areas that are kind of moving in the right direction, but aren't quite there. They're not the best schools, but they're very good schools. Population, is growing. Schools are good. Crime is good. There's access to major CVDs inside of 30 minutes that are growing that we can draft off of. When you look at it, like we've done Murfreesboro, 30 minutes outside of Nashville, Rock Hill, 30 minutes outside of Charlotte, Somerville, back in the day, it was North Charleston, even Atlanta, like we kind of went around that wheel and played in and around that 30-minute side. For me, it just felt like it was trying to find the areas that had positive momentum that we can get into before they were fully priced by the market.
Hmm.
Knowing that it may take a little bit of time, but this is an area and a location that I'm comfortable being in, that I'd be okay if we were here for the next 5 or 10 years. Um, yeah, I think that's probably the number one driver, is finding the access to the CBDs that are growing, and where is that growth pattern going. How is it? What are some of the other submarkets that have already been priced to perfection and have exploded to a point where they're unaccessible? Is this the next one for that gray collar employee? It's a lot of what we focus on in that 30-minute ring stuff, is really gray collar
Yeah.
housing. Like, I don't call it blue collar or white collar. It's kind of that, you know, 55 to $100,000 household income demo, that you can provide them. Maybe the schools are 6 out of 10. They're not 9 out of 10,
Hmm.
right? Your crime is almost non-existent. You have access to national retailers, and you're going to commute, maybe 35 minutes versus 25 minutes or 15 minutes to be closer in, but you're getting a 20%, cost of living savings for being in this submarket.
You're getting cost of living savings for bigger space than the urban
Yeah.
core. You're getting usually what I've been finding is like you're getting, with the gray collar families where there's a little bit more stickiness, there's a lot more retention. And if you're running a nice, well-run property, they'll stay. They respect the property as well. You're not getting a lot of people that are coming in, coming out, coming in. The renters by necessity for the most
Yes.
part.
Yep.
I think
Yep.
that's really big. Whereas sometimes when you even buy high demo areas, they're choosing between buying a house or renting out your apartment. That could get a little tough from, even though it's a great demos, it might not be the easiest operation.
Yeah, and we've seen that. We play in new development also, right? So it's kind of a double-edged sword, where you're getting great demos, like these are the people you want, but we're looking at our turnover, and it might be at 50, 51% retention, versus some of our kind of what I'll call gray collar workforce plus deals are running at 60, 62. And I'm like, why are we losing people? It's not because they don't love the place. They don't, they love the community, they love the location, but 9 out of 10, it's buying a home, buying a home, buying a home. So it's kind of a little bit of that double-edged sword, where these
Yep.
are demos you want. They're great tenants. They pay their rent. They take care of the community, but they're going to be more inclined to go out and purchase. But yeah, we love that. 50 to 55 to $100,000 household income. To your point, it's a nurse, it's a teacher, it's a cop, it's a store manager. They're for better or worse, in our world where we are right now, they're less inclined to be able to go out and buy a home.
Right. And I think wage growth is also strong in some of that gray collar
Yeah.
sector too. And
Yeah.
we
There's a little
always
more elasticity.
we're starting to even look at what is most exposed to AI right now
Yeah.
of in
Us
terms of
too.
job replacement. And I think the gray collar is actually the best place to be in regard to that. It's always very hard to predict, of like
Yeah.
there's just so many forces, but that's our thesis at least of like that gray collar space is a good place to be.
Yeah. I don't
Um,
disagree.
yeah, we both self manage, and you're finding that in this cycle, I think it's more important than ever. At least pre rate hike, if you didn't self manage or you weren't a great self manager, you could get saved by rent growth. Now you got to really be on the ball, and you got to really be sharp with weekly occupancy updates and where are your bad debts looking like, and just be proactive. So tell me a little bit about how it's been self-managing in this cycle. What are some of the lessons learned? How have you guys been improving your self-management heading, into this down
Yeah.
cycle?
Yeah. I mean, I think it's critical. And we've always operated quasi self-managed. We became official, I think, the end of 22. So it was kind of a good segue for us. We ended up getting fired to some extent by our management. They're good friends,
Hmm.
and they basically came to us and said, "You're never going to be happy until you have absolute total. We've let you kind of operate in a silo for as long as we have, for 5, 6 years. But when we added development, they asked us to use their new development team, and it became very contentious because their team just couldn't move at our pace that we demanded of our people. So when we
And
hit that point, they kind of came and said, we manage for private equity, institutional, and syndicators alike, 50,000, 60,000 units. You guys are the most hands-on. You're never going to be happy. Just
Manage
take
the
the front.
manager.
Yeah,
Yeah.
just take the front end of the business and we'll continue to support you on the back end. So, which was amazing. I was like, so you firing me? He's like, no, I wouldn't be offering you this if I was firing you. Trying to set you up to just don't talk to us. We'll support you on whatever you want to do. Just do what you want to do on the front side. So it was great because 22, 23, we didn't buy anything. So we were coming out of selling. We sold 13 assets between 2019 and the end of 23. We really didn't buy much. 21, 20, we bought one deal in 22. We started one development in 21, I believe, or 22. And then we were down to 5 or 6 properties going into 23. So it was a good kind of year to segue and transition. And then came 24 and we turned the faucet on and said, okay, we want to start buying and start accumulating. And we woke up at the end of 24 and I'm like, oh my God, we have like 50 employees now. We just added another 6 properties to the portfolio. We now have a real management company. And I've spent a lot of time over the last year and a half in that business. I'd say probably more than 50% of my time has been on that side of it until as of late, we just brought on a fantastic COO. And for us, there's no other way to go about it. I mean, we're too hands-on. We really work to build a culture of one, meaning we're one team, we're one vision, we're one goal. Like I spent a year breaking down the us versus them mentality that property managers have with ownership. I think that was a critical path forward for us. I didn't want our site teams looking at our investment team as owners and oh, the owners are coming. I would hear that way too often. You know, everybody's getting nervous. The owners are coming. I'm like, whoa, we're all in this together.
Yeah.
Like there is no us and them. I don't want to hear my investment team saying, well, they did this or they didn't do that. And I don't want to hear the manager saying the investment guys are too aggressive. They didn't have,
And you could
they
only
didn't think
accomplish
about
that
this.
from self-managing, by the way, right?
A
Like,
hundred
yeah,
percent, 100%, right? Third party, there is no doubt you're them
yeah.
when you're an owner, right? You're always going to be treated as them. As an owner and third party.
And
So
their goals for third party is like, hey, let's make occupancy as high as possible, but maybe not push rents. Or hey, let's try to offer concessions right away so we could get to that occupancy level instead of saying, hey, no, we need to actually try to prove out the upside here. Don't just give these out. So there's
yeah,
just there's such a different strategy with the space we play in, and self-managing is critical rather than just giving it out to a third party where the alignment of interest is completely different.
well, I think you saw it, right? I mean, if you look at everybody was a great manager in 2020, 21, 22, and anybody with a heartbeat was getting their rent raised 10, 15, 20%, and it was easy to buy deals. I think what people are starting to realize is it's very easy to buy deals. It's not very easy to operate deals. And we've seen more, oh, there's a management issue or it's a management play story deals in the last 24 months than I saw in the last 15 years
Yeah.
because things got hard again. And now these
Yeah.
third parties had to actually start putting the time in
Right.
to figure things out. It's been a challenge, but for us, it's, we are really hands-on. I know my service managers, I know my leasing people. I'm on team chats with all of them. I see the updates. I get daily updates, weekly updates. I do site visits personally if a property's struggling. I've conveyed that to, we have a key team in our office in New York on the investment side, about 7 of us, and everybody understands that that's how our business operates. Like we're all in this thing together. So if you have to do something, you get down there. I don't care if you have to go help, turn a unit from an extreme example. We're going to go do that. And we're going to be side by side with the ops team. But, in today's world, you have to be covering every aspect from renewals to providing great service to curb appeal. Cleanliness costs nothing. That's what I reinforce to our teams on a daily basis. Right. And we try to get our managers and our regionals to think like CEOs of their assets. At the end of the day, they're running a, 30, 40, $50 million business. They're responsible for daily activities. So you need to think like a CEO of a $60 million business. If you were running a $60 million business and you walk through the parking lot and saw a piece of paper on the floor, you pick it up.
Yeah.
Right.
Take
And
ownership.
that's how you need to think. And we've tried to do things a lot different than the archaic ways too, on like bonus structures and, recognition on, integral things when it comes to the investment plans. Where I think when you're talking about third party and the way some other folks do it, it's more like, okay, this is how it's always been done. This is how we're going to do it. We sell a deal, they get 2 weeks, 2 weeks pay or whatever it might be, or, here's your standard bonus structure. No, we want them to understand the pro formas, understand the occupancy goals, the NOI goals. And when you achieve those and we win, everybody wins, and you win much bigger than you would have by just getting paid for activity,
Yeah,
and leasing units or getting renewals. Um, so yeah, it's a never ending. It's tough. Staffing is tough.
it's tough.
It's really tough. But we wouldn't be able to have it any other way.
Exactly. I think
So
it's our core
yeah,
competency, just like it
a
is
hundred
yours.
percent.
I think another thing on our side, and I'm sure you're going through this too, is we get to have control of our tech stack as well. Because I think
Yeah,
with all um, these issues and headwinds that you're seeing in managing multifamily, you got to be ahead of the curve on tech, and that includes fraud detection tools. That includes pricing software and revenue management. So sometimes when you have like a third party manager, you're kind of at their mercy of what they're using for tech. Whereas self managing, you can actually make the decisions and be on the front lines of it to make sure that your property is ahead of the curve, ahead of the competition.
yeah, 100%. I think there's two components. It's the tech stack is real. We leaned in pretty hard. I'd say the beginning of this year, we explored all the top five revenue managers at great length, and we rolled it out a portfolio wide. We ended up going with Rentana, and it's been an absolute, huge value add to our portfolio. Extremely happy with their technology, their updates that they do. They're constantly evolving. Their support has been tremendous, and it was a massive rollout and undertaking. But we had the whole portfolio migrated over literally in 1 quarter, and we've seen tremendous results from it. It's taking so much of the emotional, and it's funny, talking about this because you talk to some other owners that have been around a long time. I was away with a couple of guys and that are much bigger than I am and have been around much longer, and he's very bearish on the world. What are you saying? When is it going to get better? It's terrible. Is anybody's portfolio running over 90%? I'm like, we closed out Q3 at 96.1 across our portfolio. And he said, what? He's like, what do you mean? I'm like, we're 96.1%. He's like, well, what's your bad debt? I'm like, 1.3. And he's like, there's no effing way. Like, what are you doing? I'm like, do you use any sort of revenue management? He's like, you mean like LRO or yield store? I'm like, the world's evolved a lot since LRO.
Right.
It's not just about daily pricing. It's about managing your expirations on a go forward, educating your teams, tracking your traffic, tracking your comps. And this is all done real time on a daily basis. It's working. It's pulling every piece of data from Yardi on a daily basis and showing our teams how to lease appropriately today, right? We're overexposed 12 months from now in the month of November. So you know what? We're leasing the next 5 apartments on 10-month leases at this price. And if somebody demands a 12-month lease, they're going to pay $150, $200 more for that lease. And we're going to get paid for that overexposure on that. And then the same goes for renewals. We're going out ahead of time. We started working December renewals in June
Hmm.
because I learned from last year we had a really
Especially in the
Q4,
winter. No, yeah, winter's
Q4 and
tough.
Q1 was rough.
Hmm.
Early, end of last year, beginning of this year. So we learned from that and we started working our exposure. But Rentana has been a great fit. We have all the snapped and all that stuff on the site level. We're actually working with a firm. One of our investors has been in the prop tech space for years, and he's created an AI platform that's dedicated to asset management, where I mean, the amount of data that I'm getting updates daily that they're loading into this, it's all of our Yardi reports, all of our loan documents, all of our construction budgets is all getting loaded into this, whatever I'm not an AI guru, but call it a large language model that's catered to us, that we can then go in under same chat GPT type functions I want quarter over quarter, I want week over week of this, and it's spitting out reports, and we can constantly add whatever we add additional assets to it. I think it's going to be game changing for our regionals. It's going to be game changing for asset management. We're kind of one of the first beta users for it, but I'm happy
Hmm.
to share that, in a couple months with you, because I think it could be really interesting for our
Yeah.
space. Because there's a lot of companies that say that they do that, but these guys have a deep experience in all things like prop tech that's dedicated to multifamily over the last decade plus. And he understands that they're investors first at the end of the day, which is critical when these guys are building this stuff out. They understand what we're looking for. So that could be really interesting.
Yeah, and it's about, once you do that, it's about it getting everyone on board, right? Like sometimes the pain points can be tough getting on sites
Yeah.
on board, getting maintenance staff on board, and then getting people, in the back offices on board. But I think once you can get everyone to buy in, which again, going back to having the team on your, under one umbrella, you can control that and dictate that better and choose the right talent that's embracing that technology instead of shying away from it.
Yeah, and it takes time, and that's what I ended up putting my buddy in touch with Rentana, and he's like, this is exactly what we need, and I reiterated to him exactly that. I'm like, the rollout part is easy. The compliance is where the secret sauce
Hmm.
is how the secret sauce is made, right? Because it's garbage in, garbage out. You have to ensure that someone is going to be the lead on this day over day, week over week, managing the compliance of this, because if the info is not put right into Yardi and the machine's pulling from Yardi every day, it's going to throw everything sideways, right? If the tours aren't being put in, the applications aren't being put in, the denials, the comps aren't being put in appropriately, it's going to throw it sideways. And we have compliance checks every week. We're getting a report on compliance across all the sites, and that's where I think the differentiators come in terms of there's a lot of tech out there that we could all spin our wheels with, but it's how do you really apply it and execute it for the long term.
Yep. I want to switch gears really quick
Sure.
for the time we have together. The toughest part I would say of this cycle has been capital raising, I would say, in some regard of just the type of capital that used to be in the market pre-rate hike versus now the capital that's not there. The institutions feel like they're out or being selective. The high net worths are out there. And so it's all about kind of sticking to your guns right now with the investors that have invested with you through cycles, which has been amazing for us. Talk to me a little bit about how you're capitalizing deals today, and how that investor sentiment has maybe changed and how you're kind of working through that.
Yeah. I think for us, we've really kind of maintained our same structure, through the last 15 years. We haven't deviated. We didn't lean in and go the institutional route when we probably could have. We really continued to focus on our private capital relationships. And that's a combination of ultra high net worth, single family office, and friends and family. We probably have about 300 active investors at this point, close to $300 million of equity under management. In the last, since January of 24, we raised a little over $100 million, all private capital, to do the 8 deals. And I think we have two more deals that are coming up in closing, and that'll probably be about 27 million across those two deals. And it's been our investor base that's been with us for, many since the first deals we did back in 2009 to the majority that have been with us for more than 5 years, and a handful of kind of new relationships that were introduced over the last like 2, 3 years. Our investors, I think, fortunately, we sold a lot leading up to this to kind of prepare for it. We didn't know when it was going to happen, how it was going to happen, to what extent it was going to happen, but we were net sellers, and it was hard for 2 years, really 3 years. We were net sellers and kind of watching others kind of blow past us on unit counts and transactions. And thankfully, we didn't really kind of drink from the fire hose on the equity side and try to grow during that time. We sat idle, we sold deals, we returned, we didn't do a lot. So when we were ready to lean in, our investors were there, and very grateful that, they followed us back in and they followed our lead and understand that we're maintaining our disciplines and we're trying to recalibrate. We sold all of our 70s stuff. Our product profile now is probably average vintages in the 2010s ish, between our new development and everything we bought since 24 has been 1999 or newer, as new as 2023 vintage, across the 8 or 9 deals that we bought to date. So, we've kind of reshuffled the deck. The messaging to our investor base has been, we want to buy good assets at an attractive basis, take advantage of the dislocation that's in the market. It might not be distress, it just might be seller timing, whether
Mm-hmm.
it's a family that's, second generation that just wants to sell and they're not transactors. So they're just going to sell in this market and meet the market. And that alone right there is going to create some value because, as my good friend Sam Zell, I got his book on my desk all the time, says, liquidity creates value. And right now, there's not as much liquidity as there was 5 years ago. So we feel like this is a good time to be buying, and our investors get it, where we've kind of gone in with the thesis of, hey, we're going to buy good assets, good markets. We can have a clear path with realistic assumptions to get to a 6 to 8% cash yield inside of 24 to 36 months, depending on, the opportunistic nature of the transaction. We feel like we have a free call option on when to sell that asset in the future. We'll wait as long as we can want to wait for the market to tell us to sell. We have three kind of underlying core values as a last gut check is, do we want to be in this market for 10 years? Do we want to own this asset for 10 years? And are we capitalized appropriately to own it for 10 years? We can't say yes to all three. I'm not doing the deal today.
Yeah.
And our investors, thankfully, I gave you kind of a long answer, but we've stayed true to private capital. We are having a lot more conversations right now than we've ever had with family offices and kind of mid-sized private equity. I'd say funds that are kind of in the $100 to $250 million range that write $5 to $15 million checks. I don't think there's been a ton of groups in our market specific that have been as active as we have been over the last 24 months and been able to actually get deals. We've done some deals in 27 days from contract to close, all cash purchase, $22-23 million deal. So we've been able to, when we pick our spots, we lean in aggressively to get those deals done if we feel like they're checking all the boxes, that it's willing to take the risk in today's environment. And our investors have followed suit. And if we can continue the path that we're going on and add one or two strategic partners in the family office space or private equity space where we can marry up our 300 plus relationships with, some programmatic one or two strategic partners, that's really kind of our ideal pathway for the next 3 to 5 years. I have no desire to really go the institutional route on equity. We're a family kind of run business, entrepreneurial, and we want to maintain our roots there and not have to pivot from that.
Yeah, and I think the pros with that strategy is you can go against the herd a bit, right? Because some of these
Yeah.
institutions, they're just paid to take a very
Yeah.
specific type of risk. And
Hmm.
that specific type of risk, if everyone's kind of doing the same, very hard to find asymmetric returns, very hard to find outsized returns. And so it can only really, these type of out of the box strategies can only really be accomplished with some of this private capital. I shouldn't say only, but it's much easier
Yes.
to talk to someone who might either not be in the industry or is a family office that has invested through different cycles, that sees where you can go against the herd and go against the grain in order to find outsized returns. So I think one of the interesting parts on our side is our shift in investment strategy of used to you looking at ROI and return on cost, and now kind of really focus, like you said, on cash yield and day one cash yield today. And it's a matter of protecting downside and kind of letting the upside come rather than
Yep.
trying to chase or make a deal work. Rent growth has been flat. ROI, on value add deals
Yeah.
are not what they used to be. And your group and our group, we cut our teeth like renovating
Yeah.
the
That's what
kitchens,
we
and
did.
that's what we did. That was our MO. And now you're finding that you got to switch the strategy a bit. I'm interested to hear, has that strategy switch resonated with your investors that have invested with you and say, Chris, like, we used to buy things at, very low caps and we're going
Yeah.
to, increase the NOI by 100%. What's going on? Like,
So
what's the play? Like, how have you been able to kind of resonate that with your investors that have been investing with you time after time?
I think that's a great question. We do have some of our old school investors that have seen us and know us as like this deal is an absolute nightmare that we're going to present to them, and that's when they get excited. Like
Yeah,
you said, it's
yeah,
vacant, it's a disaster. We have to do
yeah.
a $10 million renovation. And they're like, "Oh, this one's not ugly enough for me." When we show them a 23 vintage deal, and that's when I have to sit down and be like, "Okay, but we're still opportunistic in nature,
Right.
right? We're buying this deal because there's a loan maturity, there's pressures. We're buying it at a significant discount to not just replacement to what anything's traded for in the last 24 months,
Yeah.
and we're hitting a risk-adjusted return at 60% leverage of a 14 or a 15." Right? So let's take a look at this, right? Just because it's not ugly doesn't mean it's still not a
Crazy,
great
crazy
deal.
how conditioned we've been from like the
Yeah.
10-year bull run of every time we see
Yeah.
a dilapidated asset, we just get so excited. We're like, wow,
And
so much opportunity.
absolutely. Like I could put out tomorrow a vacant deal with the same return profile as a brand new deal
Right.
and probably be oversubscribed in 5 minutes on the vacant deal and have to make some calls and explain why we like the nice brand new deal at the same return profile.
Right.
So that has adapted a little bit, but I think as our investor base too has kind of shifted upward, we have a lot of very ultra high net worth guys and gals that we've been fortunate enough to build a great relationship with, and they've been great partners for us. I think they really understand it, and I think that we're able to be a little more long term greedy in our approach on things as well, and they tend to like that. Where they're okay if we want to look at a deal, on a 10-year horizon, knowing that we're still opportunistic sellers, the same we're opportunistic buyers, but they're okay if we say, hey, you know what? We want to hold this deal, look at it, maybe refinance it in 5 years, hold it for another five. We're really bullish on the market. They like that. They appreciate it. They like the idea that they don't have to get their capital back necessarily and redeploy it again in 3 to 5 years,
Hmm.
that they're getting good tax efficient cash flow. But they also know that, and we're sharing with them that we're not just out there buying, the first deal that hits the inbox. I mean, I think we're up to probably like 247 deals this year that we fully underwritten to get to the four deals that we're ultimately going to close out by January for this year. Actually, three only. So it's they appreciate the effort that's going in, and they realize that we're still buying value no matter what at the end of the day. It's just in a different dress, I
In a
guess.
different form. Yeah,
Yeah.
exactly. Exactly. So I guess wrapping it up, 2026, what's your prediction? What do you think it's going to be? I'm going to probably circle back with you at some point and play you the
Yeah.
recording and say you are right, you were wrong. So let's hear, what are some of your predictions that you're leaning in on for 2026?
Yeah. We want to continue to buy. We definitely want to continue to buy through this until the market tells us otherwise. I think we're going to see a little more distress and more urgency for the better part of 26, because of some of the things that we touched on. But these loan extensions have run their course on some of the floating rate debt that was originated in 21 and 22, and it's time to meet the market. So I think we're going to see some more of that. I don't like to get involved in calling macro stuff. It's just way above my pay grade. But in our world specifically, I think it's going to be a rough Q4, Q1, Q2 on operations, because of some of the macro headwinds that we're facing from an economy perspective, the supply, absorption that still needs to happen. But I think we start to see some of the light at the end of the tunnel by the time we hit Q3. Um, Outside of that, we're prepared to kind of muscle through till 28, you know, if we have to. So we're keeping expectations tempered. I don't think we see, organic rent growth in 26. I really don't, as much as I want to say yes. I don't think we see it.
Yeah, and we're obviously doing like a broad brush on the market.
Yeah.
So some might turn positive more than others, but I think you're right. I think we're seeing the shift from cap stack distress to operational distress, and the operational distress, the cracks really starting to show, and the cap stack distress now forming into sales, where before the past couple of years that cap stack distress didn't necessarily translate to sales. They got a loan mod, they got some sort of pref equity to kick
Hmm.
the can down. I think now you're seeing that you're going to see some assets realize due to just the runway being up.
I totally agree on that. I think one segment of sellers is, we're seeing the kind of shadow distress start to come to light via pref equity, forcing sales, especially on some of the newer development, where we've been tracking all the maturity data and the profiles of deals that were bought, very, very closely since ad nauseum since, kind of the end of 22, 23. I've had all kinds of maturity lists hammering our guys, and it's been nothing, 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 or very little bit. In the last kind of 90 days, we're starting to get a lot more calls on, hey, pref is done. They're forcing the sale. They're pushing the developer out. And those are great deals because they weren't over levered like some of the existing value add deals that were bought, with this bridge money, where even
Mhm.
at the debt levels, it doesn't make sense. These were done with bank debt, but then they slapped on a piece of pref. So if you can take out the bank debt and the pref on newer deals, a lot of times you're talking about a 190s basis on to 200, maybe 205
And the
on
pref
product
probably
that's,
got it. Yeah, and the pref probably got to like a 5-6 debt yield, which I think is like a reasonable cap rate, right?
yep,
Um, Depending on the
absolutely.
asset.
And they don't need the up. They
Yeah,
don't care that the developer's getting wiped. As
right.
long as they're getting their minimum multiple that's required and hitting their return, they're out.
Yep.
So it's making sure before we spin our wheels too much, who's really in control of the sale, because there's a lot of wheel spinning in those deals, right? Because the pref is putting pressure on, saying, I want to sell, sell, sell. We hit a number to take out the pref and all their accrued and pay off the loan. But now the developer is arguing with the pref, and we're stuck sitting here saying we just spent, a month on this deal, and nobody can get on the same page in terms of actually being able to sell.
Yep.
But we're starting to see some of that come to fruition more. And I think we're going to see the bottom of the barrel stuff also really come to a head at this point, from what we're hearing from some of the debt funds, that they're just done. They want this stuff off the books.
Yeah, and I think you like you said, once you start playing in these spaces where the value is starting to change from being, below the debt to above the debt, or from below the pref to above the pref, that's where you just start to see the transaction volume start to actually move. Whereas before, it was harder. Who am I talking to? Who's the one in control? That's
Yeah,
what blows up the deals end of the day. Even if the value is the value and someone's motivated to sell, there's another party that you probably haven't
yeah,
talked to yet, and you just need time.
yeah. We had a fun one. The day of closing, pref came in, tried to block the sale
Oh my
because
god.
they were even getting wiped out, and
Yeah.
the sellers had legal confirmation that they had the ability to sell, and screaming, yelling, threatening to sue everybody and their mother the day of closing. And I'm like, why didn't you guys just tell us about this? We knew this was going on. Now we're getting blindsided. Title's getting freaked out. Uh, but we got it done.
Fun
Pref
times.
wasn't happy. Yeah.
Yeah.
So it's
Fun
interesting.
times. Looking forward to seeing what 2026 has into play. Chris, it was really, really great having you on. Thanks again. Love talking shop with another GP, another operator, and as we're both in the thick of things. So appreciate your time.
Likewise, David. Really appreciate it. Thanks so much for having me.
Great. Thanks.